Finally, the markets broke out of consolidation amidst all the Trump tariff noise. What should we look out for in the coming week? Meanwhile, the dollar plunged almost 4% last week. Let's discuss. My name is Dan Slim and welcome to another episode of Monday Market Outlook. So the markets got a small kick last week after inflation numbers came out much lower than expected, cooling down to 2.1% from the 2.6% expectation, the lowest reading in 5 years. Core inflation also came down to 2.4%, cooler than the 2.6% expectation, and it is the first time since September that numbers deflated on a month-on-month basis. Looking at the inflation basket, it looks like we got lower readings across different areas, particularly here, food and non-alcoholic beverages, as well as housing, water, electricity, gas, and other fuels. But we do see a reduction also, a small reduction in other areas. So it was tomatoes giving us a high reading last month, and it's probably tomatoes also giving us the lower numbers this week. This puts into question whether the BSP made a mistake in keeping rates steady during their last meeting in Feb. Remember, the BSP surprised the markets by holding rates steady, which now puts the probabilities for a rate cut at their April 3 meeting close to 100%. Last week also saw the release of employment numbers for January, spiking to 4.3%, much higher than the 3.1% the previous month. While this looks bad, we also have to look at the year-on-year comparison. See here, we have December, January, we have December, January. So it is really a seasonal phenomenon for the January unemployment numbers to spike. So when you look at the news reports, I mean, it really looks scary if they say, wow, inflation worsens to 4.1%. But you also have to look on the year-on-year. As we are well into the dividend season, let's take a look at some of the ex-dates in the coming weeks. Again, guys, what a great time to be dividend investing. Manila Water just gave its special and regular cash dividends last Friday. Ex-date will be on the month end. We have other companies also releasing their dividend payments pretty soon. ICT and Aboitiz Power also declaring their dividends ex-date March 19 and March 20. Meanwhile, in the US, Trump tariff shenanigans continue after his remarks at the joint session in Congress pointed to a little disturbance caused by his tariff measures, particularly the 25% tariffs on Canada and Mexico, which was again, of course, postponed. So this little disturbance has managed to quote-unquote disturb the Atlanta Fed GDP estimate, which dropped to negative 2.8% on Monday, down from 1.5%, and a sharp reversal from the 2.3% growth expectation just last February 19. Personal consumption growth is now expected to be flat, and the latest confidence board reported a 7-point drop in consumer confidence index for February, falling to 98.3, the steepest decline since August of 2021. Now, US consumers believe inflation will rise to 6% over the next 12 months, which is the highest since May of 2023. This marks the third consecutive increase in expectations. Now, looking at the initial effects of tariff Trumps, it's no wonder that the drop in GDP reflects lower construction spending and sluggish manufacturing activity brought about by potentially higher home building cost up to 18%. Go through the charts. Let's start with the US 10-year yields. The US Treasury yields are now trading at levels not seen since late last year, as investors worry Trump's tariffs will hurt economic expansion and dampen the labor market, now potentially prompting the Fed to lower the cost of borrowing even at the risk of higher prices. Now, the 10-year yield has sunk around 50 plus basis points from its January high to trade at just 4.3%. The dollar index, right, is the story last week. It has continued to plunge to the next support level here at 103,427 due to the lower than expected payrolls and slight tick in US employment rate. But exacerbating the issue here really is the spike in the German government bonds, which is called bonds, adding around 30 basis point. Look at that. The German bond is used as a benchmark for European bond markets and is a key indicator of economic confidence in the Eurozone. So the bond skyrocketed on Wednesday after Germany's next coalition government allowed a significant increase in additional defense spending. Usually, when the bond sells off, now this is the bond, right? These are the bond prices. Of course, when bond prices go down, the yield goes up. Same as REITs, right? So if A REIT prices go down, the yield goes up. So as the sell-off in the bond happens, the yield goes up. So usually, the reason why the bond would sell off is when investors are expecting stronger inflation or there's a significant shift in economic policy. In this case, of course, one of the shifts in economic policy is the effect of tariff trumps. Now, in Asia trading, the bond sell-off extended into the Japanese markets, with the yield on Japan's 10-year government bonds gaining 8 basis points during Thursday's trading hours. Now remember that the dollar index is benchmarked against 6 currencies. 6 currencies with different weights. Now 56% of that benchmark is against the euro, right? So we have the euro, the British pound, the Canadian dollar, the Swiss franc, and the Swedish krone. So as bond yields go up, euro yields also going up, and the 10-year Japanese yields also going up, it's no wonder that the dollar is in free fall. Now looking at the Philippine 10-year yields, we are also going up, and the peso also appreciating to around 57.46. Now we are right in the 50 Fibonacci retracement level. The next level here would be 56.89. Actually, there's nothing there except for the Fibonacci support. So we could actually be going back to 56.50 if the trend continues. Let's go to the Philippine markets. The index finally breaking out of the 6150 resistance area on consecutive strong candles in the last 3 days. At this point, we will encounter a heavy resistance area here along the 6300 to 6350 zone. I was expecting the bounce only up to the 6150 and probably consolidate here, but the surprise inflation numbers buoyed the markets to the next area of possible consolidations. So last week we mentioned that we were going on a shopping spree as the markets looked more stable. Congratulations if you also did. I think most of the stocks you may have bought last week should have given you gains. Now, as mentioned, we got AC and SM, right? Both of them are at their resistance levels here at the 50 EMA. Now, remember where SM goes, the index usually follows. SM currently at the high end of this price range. So either SM goes back to 780, consolidates here, or it breaks out to the next area here at around 860 pesos, which will also determine if the index breaks out to 6,400. Actually, the next index heavyweight is ICT, and look at what happened to ICT after their earnings report and their dividend declaration, right? So again, the key here is to wait for ICT to retrace back to support, which is a good buy zone for ICT. Remember, that is the same scenario that we did for BDO, right? BDO, last week we said, BDO was here, right? We said it has to retest this, bounce off of that, and then that could be a good buy signal. So congratulations if you were able to buy BDO. Now, so far, the banks are the hottest sector now, with most of the foreign flows going into the financials. BPI and Metrobank all at good buy points. Metrobank gapped down because of the dividend declaration, but a good buy point nevertheless. No? So, of course, DG Plus, right? DG Plus, we said to buy on this dip right? So buy on this dip at the 20-day EMA. Congratulations if you did. Actually, this was a better buy zone, right? Now, don't mind all the noise in the news, right? Now, this happened because Chis Escudero coming out with a proposal to ban pogos, right? I mean, just look at this. Look at this. Do you remember this, right? So, this was when the pogos were banned, and then Senator Gatchalian also proposed to ban all forms of online gaming, right? Same scenario here. It is a great opportunity to buy DigiPlus. I mean, just between us, if they ban online gaming, where will they get their funds for their Tupad and IX? Right? Okay. For consumer stocks, Monde was a good buy last week, as well as Keeper. Is it time to celebrate? Maybe not yet, guys. Remember, this week we will encounter this area of heavy consolidation. So the markets might need to enter into an accumulation phase here before continuing towards what, 6450. So we have a long way to go, so be patient, right? So look at AC, right? I want to show you how this should play out. Remember that even if we hit the 50-day EMA, right, if we cannot clear these two, right, it will just continue to go down, right? So we have to squeeze in much closer to the 200-day EMA in order for the price action to have a chance to move to the upside. Are we there yet? No. We are still too far from the 200 and 100-day moving averages. So we either need a catalyst to push the price action above there and retest, or we have to slowly consolidate until the moving averages catches up and we find ourselves on the other side of the moving averages where the rally could be more sustainable, but we are not there yet, right? So if the PSEI continues to be bullish, now we might break through here. 6,450 retest here could be a good buy zone, but again we could retrace back to 6,150 and consolidate here. So really, we just have to continue to monitor the price action. So on to the global markets. The S&P 500 had its worst week. Let's look at the weekly chart, right? It had its worst week, right, since September, dropping down 3%, testing a key support level here, right? Now, if we go back to the daily charts, it briefly dipped below the support zone but rebounded to 5,765, reinforcing this as a strong support area for the S&P 500. This area is both backed by a horizontal support line and the 200-day EMA. So the focus for this week is whether the index holds or breaks down from this level. The doji candle forming at this support here could suggest a potential rebound. But looking at the 2-hour charts, right, what should the S&P 500 do? It should be able to clear 5,850. Look at the consolidations here, consolidations here, consolidations here. So this is a key resistance area for the S&P 500. It needs to clear 5,850, retest, and go up so that we can have a chance for a reversal for the S&P 500. So what could be the catalyst for next week? JOLTS numbers on Tuesday and the inflation rate on Wednesday. I mean, guys, just hang on to your butts, right? Looking at the market breadth, the S&P 500 not looking good, as there are now less than half of the index stocks trading above their 200-day moving averages. So while the index is hanging on to dear life at the 200-day EMA, most of the index names have already fallen off. So this could be signs of things to come. Looking at the put volumes, the March 4 put volume is close to the same levels as there were the last two times here, indicating that markets could experience more downside. The daily sentiment index also at critical highs, as fear in the markets have started to come to some pretty dangerous levels, especially as 40% of household assets are now in equities. Interesting stat here. Previous times we've hit these levels, the market enters into a lost decade. Hopefully it doesn't happen this time around. Hopefully we are just following a seasonal pattern, as we've been closely tracking the traditional post-election movement of the markets. So we could still see some selling pressure here, consolidation, rally a bit, and probably a couple more months of choppy movement before the markets may continue on its usual trend, right? So that's it for this week. Please like this video if you found the information useful. Please subscribe to the channel for more updates. And again, good luck on your trades. Please manage your risk accordingly. And I'll see you again next week. Bye-bye.